This is the Converge Podcast, brought to you by the Converge Institute. Each week, brilliant minds specializing in AI, blockchain, and fintech come together to challenge the status quo and empower disruption. Sponsored by our founding council, Nakusa, BankSocial, the Texas Blockchain Council, and the Universal AI University.
All right, here we are, the kickoff to the Converge Institute, and how exciting it is to have Mr. Ken Hersh here, a titan of industry, as they say. Here with my co-host, as always, Mr. Lee Bratcher from the TBC. How's it going, Lee?
I'm pumped. We've got a great audience coming tonight to talk about Mr. Hersh's book, talk about U.S. competitiveness and emerging technology, and it's an important topic given geopolitical events. And we just were overlooking the Bush Center, and that's right across the street here. I think there's people that are thinking about things from a business and economy perspective, from the level that Mr. Hersh is. They're also seeing the international relations and geopolitical perspective too, and so that's important to kind of pull out and tease out. But do you want to let's start off with a
quick intro of Mr. Yeah, I think that's what everybody's here for, is a quick intro of Mr. Hersh.
Why am I at a convergence crypto audience?
Well, it's the whole idea was we didn't want to be crypto, we didn't want to be AI, we didn't want to be, it's kind of converge, because those ideas can always just kind of
So you found the least crypto person you could find.
That's right, and you're interested in what we're doing. How cool.
Okay, here we
A
go.
little bit about yourself, and
Yeah.
they'll probably be familiar with your
They
book.
should grab the book.
They
should
should
grab the book.
Yeah, you can read The Fastest Tortoise and learn more about me than you probably care to know.
I can't say that happened to me. I was quite fascinated with the book. So
Well, good. I appreciate that, because that's why I wrote it. I'm relatively straightforward. I grew up in Dallas, went to school here, and then went away to Princeton for college, ended up at Morgan Stanley in New York. After that, I went to Stanford Business School, and then with a little luck and a little good fortune, met Richard Rainwater in Fort Worth, Texas in 1988. And with his help, formed a partnership with some other great people that invested in the natural resources industry. We were an energy investor when that was not cool. And we started in 1988, and I was there until 2016. The firm still exists today and is thriving, NGP Energy Capital Management. And then in 2016, President Bush, who I met in 1988 when I could call him by his first name, asked me if I would take over the Bush Center. Margaret Spellings had been recruited away to go run the University of North Carolina. And it caught me at a right time when I was kind of thinking about Chapter 2.0 in my life and how to give back. And as I tell people, the fund management business got a whole lot less fun after Dodd-Frankenstein and Madoff affair and everything else.
Oh, this is going to be good.
It became a very different business. But I enjoyed it, and it was rewarding, and had a great team around me, and it was just time to find something else to do. And that's when President Bush, who was a longtime friend, and asked if I would take over the Bush Center. And I didn't know anything about the nonprofit world. Well, obviously I did from the donor side, but not the management side. And I knew nothing about presidential libraries and presidential institutes. And so now I've been able to do that. And as I tell my friends, the Presidential Records Act used to be really boring. But since the last president, it's become quite an interesting little piece of legislation.
You guys never got caught up in any of that, did you guys?
No.
You guys kind of made it through that unscathed.
Yeah, well, we're not really, we don't have anything to do with it.
Yeah.
But it is interesting. So that's it. That's my life in a nutshell on the professional side.
Yeah, I think one of the things I heard you say the other day, Lee, was kind of, you're thought of as maybe the father of the hedge fund. The father of private equity.
Well, I wouldn't say private equity. Energy private equity, for sure. Natural Gas Partners, which was the name of the firm when we started.
When was this, just so we get a timeline?
1988.
All right,
1988.
cool. All right, 1988.
And Richard Rainwater really was one of the godfathers of the whole private equity business.
And this is who you just mentioned that you got to meet up
right.
with.
And really, just a phenomenal human being, had a huge impact on me, had an impact on thousands of people. And he managed the the Bass Brothers money, and he was a Fort Worth native with the Basses, and when they inherited $50 million from their rich uncle, they asked him to leave Goldman Sachs, which he had started 6 months earlier, to come back and help manage the money. And that was in 1970, so about 15 years later, that $50 million was worth about $5 billion.
Wow.
And
through energy? Through
no,
investment in just various?
This is just Richard being brilliant. And through a series of transactions that your listeners can look up, that just a really phenomenal human being. So he left the Basses in 1984, or in 1986, and I showed up in his office in 1988, and at a time when there was a lot of chaos in the oil and gas industry. And so he said, what about putting some money together to take advantage of rising natural gas prices? And he had McKinsey do a study about how natural gas prices, supply was going down and demand was going up because prices were so low you couldn't drill, and prices were so low so demand was going up, and sooner or later the lines were going to cross. And McKinsey predicted that they were going to cross 2 years later. So he said, let's hurry and put some money together. So we did. In 1989, Natural Gas Partners was born. The McKinsey thesis was dead wrong. Gas prices went down for 7 straight years. Richard lost interest. He said, well, let's give the money back. I said, no, let's not give the money back. Let's figure out what to do. And so I said, well, this shouldn't be that hard. As you know, I'm a total generalist. I'm a liberal arts major with a finance MBA. I mean, you don't want me anywhere near an oil and gas well, but here I was managing money with my partners who were equally liberal arts gifted, and said, if we focus on this differently, let's just look at what an oil and gas company does. How do they make their money? Well, the equation is simple. It's price times volumes minus costs. That's it. I've tried to find other things in the equation. There ain't nothing else. And I said, if prices are going down every year, well, why don't we just find teams that can grow volumes and reduce costs? This isn't rocket science for a political science major. And so we morphed our business away from looking for assets and turned it into looking for people. Mm-hmm. And we said, why don't we find really great people who know how to operate oil and gas fields? And the old adage that the best place to find oil and gas is in old oil and gas fields. And why don't we find really great people who can take one company's trash and make it their treasure? Find overlooked fields that were supposedly fully developed, that were quote unquote harvest assets for companies that needed to grow. And the U.S. was a declining basin. We were a harvest area. You should take your cash out of the United States and go to places like West Africa, the Falkland Islands,
wow.
the North Sea, where you could find big, huge new fields. Those were the days. And so the big oil companies were divesting their domestic assets. I said, well, why don't we find some really great engineering people who can take those assets?
Yeah.
And it may be, somebody who had 200 wells that were averaging 10 barrels a day, and say, if we give these great engineers those wells, they know how to make them average 12 barrels a day.
Oh, okay, not even that much.
No,
wow.
12,
wow.
13. I mean, it's hard work, Well, but to a generalist, I'm like, 10 barrels a day to 13 barrels a day?
That's pretty good.
That's a 30% move.
Yeah.
And if I can do that on 50% leverage and compound that, that sounds pretty good.
Yeah.
And that's what we did. And we did it over and over and over again by finding really great people who they themselves knew oil and gas. And it relieved us of the pressure of having to know oil and gas.
Be expert. You didn't have to be the experts. You found the experts.
Thank God, because I'm not a petroleum engineer. I can't operate a well. I can't read a seismic line. I can't read a log. And that was my strength, because if people walked in and tried to bamboozle me, I couldn't. There was nothing we could do.
And this is what I find. This is kind of the genesis of the idea of your book, right? How you made it in places where you had no idea what you were doing, really,
and still don't.
And you had so many great nuggets in there. So I just to peel them apart a little bit more, thinking differently is something you kind of hear about a lot, but it's not employed very well all the time, right? So when you talk about thinking differently, what's the first thing you try to do when you go into a situation to think differently?
Well, it only appeared to be different. One person's normal is another person's different. Not being saddled with the technical background allowed me and my partners to be free to think about evaluating a business plan quite differently. And so if somebody were to evaluate an asset, they're going to evaluate an asset very traditionally. If I'm evaluating a company, I might say, well, let's put the asset aside because I really am not an expert to evaluate that anyway. We'll get there. But if you've spent 6 years with this asset that you now want to acquire from your prior, employer, who am I to, even if I had a great technical background, who am I to spend a weekend with this book and tell you whether or not your value is good or bad, right? I want to evaluate whether you guys are good or bad. And so we flipped our model almost to a headhunter model.
Yeah.
Where we were just saying, look, this is really simple. And this is what Richard would say. Align yourself with great people, okay? Our litmus test started with, would we trust our kids with this team, okay? If I'm gonna turn my kids over to you for a while, what questions would I ask? I wouldn't ask the valuation of that field you're showing me, okay? I would ask a whole bunch of personal questions. So that's where we started.
Right, yeah.
We started with, who are these people? And how do they think about life? How do they think about business? How do they think about risk? How do they think about money? Do they care more about returning their investors' money than their own money? Right? That you start with that. It's about aligning interests, finding great people you would trust your kids with. And if you couldn't answer those questions well, don't even look at the asset. And that really was our secret sauce.
I mean, great people is so underrated, right? That whole idea there. Let me take that down a little bit of a path here. So I've heard this idea of, you can either go at it as a missionary or as a mercenary. So when you were going after these great, and you can have great mercenaries and you can have great missionaries.
Right.
What strategy did you find the most success with? Was it finding missionaries or mercenaries?
Oh, missionaries completely. Yeah. I mean, it was all about the people. And we pivoted after about 2.5 or so years in business, and we had done 4 transactions, 2 worked and 2 Okay.
In baseball, that's 500. That's
exactly. But
pretty good.
But in investing, it was like, well, why did the deals work that worked, and why did the ones not work? Well, the ones
Sonoma one of the ones that didn't.
That was later on. That was another lesson learned.
Okay.
But this is before we pivoted. But the ones that didn't work were basically commodity price bets. That we kind of said management's okay, the assets look okay, but when prices go up, boy, the rising tide will lift all boats. These assets will be worth a whole lot more than we paid for them. Well, when prices didn't go up, what were we left with? Nothing.
Bad assets,
right.
Bad people.
Right.
Bad,
And then we went to go sell them, and nobody wanted it, right?
Yeah.
And contrast that to a couple deals that really worked, and we said, how do these guys make money? They taught us. How do we make money? Prices have fallen 30%. How are these assets worth more? Well, volumes are up 20% and costs are down 50%. Guess what? Your present value is way higher. All right? So we said, well, let's do more of that and less of the other one. And so we said, now, what was it about that deal? Was it the asset specific? And it wasn't. It was about the people who were focused. They didn't quit.
They didn't quit.
Right? The prices went down. The industry was worse this year than it was last year. And they didn't say, I'm leaving.
They cared enough to pivot. They
Correct.
cared enough to find a way.
They said, let's find a way to reduce our costs. Let's find a way to increase volumes. Let's try something different. And by doing that, we isolated people who loved the oil field. I mean, these are, and so that's the problem, in life, I would say, as you do better and as you get more experience and as you get older, what happens? You get promoted. And then you do a good job there, you get promoted, right? Well, pretty soon you're a long way from the assets, okay? You're up in the strategic level, okay? You got there by starting as a great production engineer, all right? But what we found is that there's a certain quality of people that missed their days in the field. And they would say, you know what? If I knew then what I know now, that old field I got started in, I could triple the damn value of that thing. But now they're running $1 billion division. And if they were, if they said, I got a great idea on how to triple the value of that $10 billion field, their board will say, what are you doing? I need you working on the $1 billion idea, not don't turn 10 into 20 or 10 into 30. What are you wasting your time for?
Yeah.
Right? You'd get fired for that idea.
Yeah.
Right? Because they need you focused on where you should be focused. But there's a certain quality of person who misses that. And they love that entrepreneurial, that satisfaction that comes from making something out of nothing and not managing a big enterprise. Other people are like, I don't want to go back in the field. That was a hard day. And I can't wait I love it up here on the 30th floor. They don't want to go back.
So do you feel like this was a culture of the institutions you guys built? Was this a culture? Yeah.
Totally. I mean, we found those people and you could see them. You could see their passion. And you could say, and so the questions you would ask them that I would ask in a meeting is, what are you passionate about? What do you want to be doing 5 years from now, 10 years from now? And when you build a company, what excites you about building the company? And some people are I don't know, they're just not excited by the minutia. And some people are like, I just love it. I just love taking well files home at night. And I've been promoted so many times, I'm taking Wall Street research home at night now.
So it's just finding the passion.
It's finding the passion, and then it's finding people who then understand what it means to build an enterprise and build a culture. And I always say that a culture is an output, not an input. People say, oh, I want a really transparent culture. Oh, that sounds great. But then what do? They go to their locked office, with no windows, and they sit behind their desk and they never come out. Well, you're not going to build a transparent culture because you can just fiat it, right? So you have to live it and you have to breathe it. And it's an output of all your activities and all your styles. And then as you build your team, the culture changes with every person you hire. Culture is like this amoeba. If the people in this room, if the 5 of us said we're going to start a company, our culture would be an amalgamation of all of our personalities.
Right.
I could say, no, I don't like it. I want to do this. But if it's not your personality, if it's, if it doesn't match one of us, guess what? We got 80% of that culture. 20% is now something else. And you just got to own that. So as you morph your organization, your culture, as you grow your organization, your culture has to morph into fit all of the people. And that's the big mistake that we saw certain people make that weren't great managers.
Like who? No, I'm just playing. I'm just playing.
But knock wood, we were way more successful than with winners than losers. And so that was a big a big part of our formula was really zeroing in around the people and the people issues, and making sure these people knew what they were doing, not just in the field, because you could undo really good work in the field if you screwed it up, at headquarters. Yeah. And you can overcome problems in the field if you were strong as a team at headquarters. And so that was the magic of NGP, Energy Capital Management, and that's the formula. That's why we were able to do so many repeat deals over and over. After we sold the company, we started over with the same team and did it again. It's easier to take a company from 50 to 500 than from 500 to 5 billion. Yeah, so take it from 50 to 500, sell it, and start over with another 50.
Yeah.
And just do it as many times as the market will let you.
Rinse and repeat.
That's what we tried to do.
So on culture, I want to pull on that thread a little bit more.
Yeah.
The Converge Institute, one of the taglines is empowering disruption in AI, digital assets, and fintech. In the book, you talk a lot about empowering your team members. And it seemed to me that, in the 90s and 2000s when NGP was dominating with some of those funds, when you had the energy transfer deal and all of these things, it seemed to me that empowering your team members was ingrained in the culture to the extent that, was there no one that left the firm, no
24 years.
Left the firm
Wow.
24 years?
Wow.
No. I mean, that's unheard of.
Yeah, how did you, it's more than just setting a culture. What were the components of the culture that if you had to put 3 components of culture that sat on the top of the 24 years of brain trust you built, what were they? Or 2, give us 1.
Well, inclusiveness, to making sure people felt like they were part of something. Transparency, to make sure everybody knew where we were going, and that they were, before that was decided, that they were involved, that it was the output of what everybody wanted to do. making sure that the goals were clear, making sure that the ownership was spread, making sure the responsibility was spread. There were periods of time where my co-founder David Albin and I, our compensation went down for 3 or 4 or 5 straight years because the growth in our firm was shared because we grew the headcount. And so we had to make sure that people got compensated the way they needed to be compensated. We took what was left, and not the other way around. And
so you walk the walk. You put all these things
to.
in, and you guys were a part of that critical part of the culture.
And I wanted to make sure that we had a team that really loved coming to work and loved each other. And we were a family. And we were personal friends, not just business partners. And so that, to me, it was all part and parcel of the same formula, which is to make sure that everything held together, that we weren't a bunch of free agents. And that way we did more. If I had to go to every single meeting and with David Albin or my other partners, because we couldn't trust the other people to go to the meetings, I mean, we couldn't have gone to as many meetings. We wouldn't have got as much coverage.
Yeah.
Right. So we spread the responsibility. We made sure people were happy. I spent a lot of time with individuals asking them, you feel good about where you're at. Where do you want to be 5 years from now? Where do you want to be 10 years from now? And the people who opened up and said, "This is where I'd like to be." One of my junior partners said, one day he was a petroleum engineer, and he said, one of these days I think I want to go back and run something. And I said, "Good. Let's just remember that." And lo and behold, a handful of years later, we had a company. We wanted to put a couple companies together and take them public. Who could run it? And I said, "John. Hey, John, you've always wanted to run something. Here it is."
It is.
Right? And he didn't have to leave, right? It was so open and transparent in virtually every case that it really made it a joy. And as we grew, and I explained in the book, it's not foolproof, and not everybody can be accommodated for every single eventuality. And eventually we had some turnover. But I'm really proud of that culture that we built. And like I said, the firm still exists today. And for a private equity firm to do a full transition from the founding group to the next generation and hold together is really rare. And now NGP is now 35 years old and doing great under Chris Carter's leadership. So anyway, people ask me what the secret sauce is. It's a whole lot of little things.
Well, it starts with strong leadership. It starts with strong, intuitive leadership, feeling what's working, feeling what's maybe. I mean, but it's putting a lot on your shoulders, or maybe you and your partner's shoulders. But
we were sweating it out. I mean, it was a very volatile industry and a very volatile time. And,
well, what were the things that you did? What do you think? What did you contribute to that culture?
Well, I'd say the most important thing is don't quit.
So you created that mentality of, you're going to see me here. I ain't quitting no matter what's happening. I'm going to be here tomorrow, the next day.
Well, and we were stewards of other people's money. And so I cared deeply about making sure that the funds did okay. And so if we had to pivot, we pivoted. And so that was huge. And there were times in the financial crisis that we had to remind people that, what goes down will come up, and what goes up.
And we've got smart people, and so we'll make it through the.
And you know what? The last deal didn't work, but nobody lied, nobody cheated, nobody stole. It just didn't work. Okay. However, the same conditions that caused that company not to work, maybe they're causing opportunities over here where we can go make acquisitions and start the clock on those deals from a really low base, right? And so, every time we got lemons, I said, there's got to be lemonade here somewhere. And as a leader, you got to stay optimistic. You got to stay in there, okay? And you got to be real. So false optimism will be seen through in a second.
Yep.
Okay? Then you're phony baloney.
Yep.
That's not it.
You lost it then.
Right. So it's okay to say, gosh, that hurt. Damn. Let's do a postmortem. Let's figure this out. But let's reward people for sticking here. Let's make sure people understand the drill. And if we want to fold up tent, we're going to make a joint decision to fold up tent. It's okay, but fortunately we didn't. And you look in the 97, 98, 99 time period, When oil prices went down to, $9, $10, Russia was defaulting on their debt, long-term capital management, hedge fund was blowing up. The real financial crisis, that's when I described our Sonoma deal that got hit because our bank decided they weren't going to fund a commitment, and we were undercapitalized. There were people in the oil and gas industry who said, I'm out of here. Okay? I'm going to go chase my internet dream. And then, because what was hot right then? The internet. Okay? And then in 2001 hit, the internet crashed. All right? They come back to the oil business. They missed the whole turn.
Right. Yep.
Right? The whole unconventional shale revolution started in 2000. So if you had left, you missed. And that unconventional shale revolution emerged from the crisis of 97, 98, and 99. Because prices were so low, people were like, we got to figure out how this thing works.
Unconventional. The smart people had to get in there and get unconventional.
And they were trying to figure out how do we do anything to increase recoveries.
Yeah.
And so they were experimenting with things. And then when things turned, because low prices cure low prices, demand went up, supply went down, then prices tripled and quadrupled. Now they were able to try things like horizontal drilling and hydraulic fracturing that they were experimenting with earlier. So it all kind of ties together through these cycles. So as a leader, reminding my team, this is a cycle. We've lived through this before. It will be okay, right? I think that was important. And you don't know, and it's easy to write about now and intellectualize what we had done, but at the time we were just making it up as we went along.
Well, this is the intuition part I was wanting to ask you about. I'm not going to go too far deep into that. We're a few minutes away from being at 30 minutes, so I think we want to jump out here. But we always try to end these with a piece of advice for the listeners out there. If you had to give one piece of advice, and it could be intuition because I really like that topic, but it doesn't have to be. What would that piece of advice be?
Feed your winners. Okay. And in life, we have relationships that are positive, that you draw energy from instead of get energy sucked out of you. Feed those. In your portfolio, you have great teams that are working. Those should be your biggest investments. Okay. What I see people do is spend a whole lot of time getting dragged down by their losers. Okay, so if you have two portfolio companies and one that you invested at $10 in each, and the one has gone from being worth $10 to $5, and the other's gone from $10 to $20, okay? Most portfolio managers will spend their time on trying to get the $5 back from the one that's not doing well, okay? Well, why? Well, it's because they picked it.
They don't want to lose.
They don't want to lose.
They don't want to lose. They're afraid to lose.
The winner. Why is the winner winning? Of course it's winning. I picked it. Yeah. I knew it would go up, right? Let that one run. Now let's see what we do with the loser. And they spend all their time on the loser. Well, guess what? That $10 bet is worth $5. Okay? $5 of that value has gone to capital heaven. Okay? And it's gone there for a reason. Okay? Whatever reason. Your strategy, your management, the market, whatever. Okay? But so to turn that 5 around is really hard.
Yeah.
And if you make a double on it, you'll get back to even. 5 to 10 is a double.
Yeah.
Okay. Now, conversely, if you look at the other company that's gone from 10 to 20, it's gone from 10 to 20. The management's working, the macro bet's working, the team's working, whatever it is. Why don't you put all that energy in doubling it? It's the same double.
It's the same double. The same double.
But now it's going to go from 20 to 40.
Yeah.
Right? So even the 5 could drift down to 2 on the other investment.
Yep.
And if you can turn your winner into a double again, you're going to be way better off. And what I see, this is why, most pension funds in America underperform the market. Because what do? They look at their allocation. And when a stock goes up, they're now over allocated to it. So they have to trim it.
Yeah.
Right? So what do? It's like having a garden. You clip all the roses, but you keep the weeds.
Yeah.
It's the dumbest thing ever, but that's why every pension fund in America virtually underperforms, because what happens? When technology runs, they're going to say, oh my God, according to our allocation model, we are overexposed to technology. Yeah. So they trim it. Congratulations, you sold Microsoft about 1,000 points ago.
Yeah.
I mean, it's just the dumbest thing ever.
Yeah.
Absolutely. So they keep their underperformers intact and they trim their winners. don't do that. Don't do it in life. Don't do it in your portfolio. How's that?
Man, that's fantastic. Well, we could probably talk for another hour. I know I could, but we're going to get to the opening of the Converge Institute. So let's go ahead and wrap this up. Man, Ken, that was fantastic.
Well, thank you
Thanks
for
for all
having
that.
me.
I think people are going to love that when we launch this. So we'll wrap it up. Lee, always a pleasure to be on here with you. And again, an extreme pleasure to have you in with us today, Ken Hersh. Get the book if you haven't gotten the book.
The fastest
Get the
tortoise.
book, The Fastest Tortoise. A lot of great wisdom in there right off the heels of this. Thanks again, Ken.